Pankaj Tibrewal joins us. Let's take a conversation forward. The Senior Vice President and Fund Manager with the Kotak Mutual Fund. Good morning, Pankaj bhai. कैसे हो? I always get to see you when markets are strong.
That's a problem that last 18 months markets have not been gone anywhere, but we have been meeting. So uh,
We've been
let's
meeting
see.
not on television. We've been meeting as friends. But I only get to see you more often on television when markets are making a new high. It's a good issue to have. I mean, now that markets are making a new high, we should see you more often.
We are always there when the markets are bad also to handle investors and others.
What's your view right now? I mean, do you think this market, which has rediscovered momentum, where things are falling in place for macros also, this market now has a strong case to outperform, and bulls who are back, they are here to stay.
Nikunj bhai, we have always believed that markets are slave of earnings from a medium to long term. In the short term, liquidity sentiment can play their own role. So it's very important for us to decode the earnings season which is going on. Till yesterday, Nikunj bhai, about 294 companies out of the NSE 500 companies have reported their numbers. And some interesting trends are to be watched out. Out of these 294 companies, 63 are BFSI companies and 231 companies are non-banking and financial services companies. In the first 9 months, December ending, we saw a huge pressure on the non-BFSI space because margins were under pressure. This quarter, there is a very interesting trend that we have seen a quarter-on-quarter strong recovery. And my sense is that margins are at 8-quarter high. And non-BFSI space has shown 3.3% earnings growth, the 231 companies. Uh, in the first 9 months, the BFSI space led the entire show with almost 50% earnings growth. That is seeing moderation. And the BFSI 63 companies have shown about 21% earnings growth. So on an aggregate basis, we have seen 9% earnings growth, which is better than the first 9 months, which we saw. So there is some momentum which is being seen on the non-BFSI space as far as margin expansion is concerned. Coming to Nifty companies, about 35 companies have reported, and the earnings growth is about 14%, which is slightly better than what the street was expecting. And the entire show and the growth is led by BFSI as well as autos to a certain extent. And in many pockets, we have seen some of the oil and gas companies also delivering strong numbers. So I believe that compared to what we saw in the first 9 months, there has been some improvement across the broader space. And I think market has started to reflect that. The second part is on liquidity. I think market has been surprised by the comeback of FIs in a very strong way. Uh, Also, we believe that the next 6 to 12 months could be very strong from FI flow perspective, because what we are experiencing as a fund house is that over the last few months, many new FIs whom we have not seen, they are looking and doing their homework on a country specific allocation, which is India. And I think over a period of time, if market remains in a consolidation phase, valuations have corrected over the last 18 months, it will give a good entry point to a lot of investors who are looking at India specifically from a longer term perspective. So from a FI flow perspective, we are not so negative. We believe that April could be a curtain raiser for the next 12 to 18 months from a FI perspective. Domestic flows continues to be strong. And also don't forget, over the last 4 months, we saw the dollar index sliding down from 113 to 102. And there is a negative opposite inverse correlation of dollar index versus Indian markets. And whenever we have seen dollar index slipping down, actually it bodes well for the Indian markets, which has been the case over the last 1.5 months. So our overall view is that in the next 6 months, whatever bad news needs to come out, either in form of monsoon news, global volatility, US debt ceiling, US interest rates going for a long pause, all those things will play out. And I think the second half of the fiscal year could come out as very strong. And this next 6 months, what we are advising investors is the allocation phase. Start allocating and increasing your equity allocations for 2024 and 25.
Okay, so that's the take coming in. Start increasing your allocation. But I was just going through the top, holdings that you have, and it seems like you have a lot of the capital good names in your portfolio as well, right? From a Cummins to a Carborundum Universal, which is a bearings play, etc. What's your entire thesis around manufacturing? What are the top stocks that you like?
So we have been vocal about this theme for last couple of years. We believe that there is a revival of entire manufacturing space in India, and capital goods is the a great proxy to play that recovery uh, across the sectors, not only uh, say chemicals or electronics, but we are seeing traction across many other industries, for example, gas utilities, cement, steel. So, large part of manufacturing is something which we are seeing a very strong revival for. Just to put things in perspective, 5, 6 years back, the total capex of India, which is state, center, and private, used to be in the tune of 10 to 11 lakh crores. And uh, this year, on a trailing 12 months basis, we have already crossed 20 lakh crores. So we have seen over the last 5, 6 years that center and state have done the heavy lifting. And we are seeing early signs of private sector capex also coming back. We used to be 4.5, 5 lakh crores by private sector capex for a very long period of time. This has crossed 7 lakh crores on a trailing 12 months basis. So these are some interesting trends which we are seeing. And probably this time it's not a false alarm. And hence we are expressing our view in the entire revival in capex and manufacturing through many of the short cycle plays, maybe bearing, maybe abrasives, and so forth. And also on the other side, we have some of the manufacturing names across various industries. So that's how we are, kind of bullish on this space. And China plus one in defense are realities which are happening right in front of us. Companies after companies are looking to diversify their supply chains. And on the electronic side, we are seeing the kind of momentum which is starting to build up at the ground level, starting with mobile phones, going on to air conditioning and many other parts led by the PLI.
How?
Pankaj, morning. Now, you have said that it's a good time to increase exposure over the next 6 to 8 months. So, identify for us which are those pockets in which you are increasing exposure.
So clearly, one which we spoke about just now, the entire manufacturing, sector. The other is the private sector financials. Um, the numbers have been quite supportive. Uh, Valuations are also reasonable, and I think this year the returns on banks and financial services should be a reflection of earnings growth. We are not banging upon any expansion on multiples, either on the price to book or P, and earnings growth reflection should be seen on the stock prices. The second one is also a dark horse called Pharma. Initial signs of the companies reported, but stock specifically, we are seeing improvement in US geography, which was under pressure for last 4, 5 years. The price erosion, which used to be about 10 to 12%, has come down between 5 to 7%. So can FY24 be a dark horse for pharma? We have to evaluate, but I think this space has also started to look interesting. The third is that uh, as a style, if you look at value has done very well over the last 15 to 18 months. We have started to see early indication where we believe that value as a style has started to peak out versus growth. And in our view, over the next 6 to 12 months, growth at reasonable price should be a style to bet on. And many of the companies which were not doing well, either maybe in consumption space or consumer discretionary space, and the numbers have been quite strong for many of those, which are leaders in their categories, should also start seeing momentum catching back again. So these are the spaces where we are looking at. IT, we believe that there will be 1 or 2 more quarters of pain before they bottom out on the earnings side. And that is the time we'll reevaluate on the IT sector.
Right. How much of the good news about a strong credit cycle and low NPAs is something which banks and financials are already pricing in? Because it's like a consensus view that banks are in a good cycle, and when there is a consensus view, then there is hardly any gains left on the table.
That's what Nikuj bhai, I said that incrementally what you are saying is absolutely right. That a lot of good news seems to be priced in, and that's why we are not saying that expect any big expansion on multiples. But our sense is that if the banking sector delivers between 15 to 20% earnings growth, it still will be better than the overall market earnings growth, and hence stocks should remain bidded. And you should see stock returns being more a reflection of earnings growth rather than P expansion. And I think in the environment we are in today, clearly the non-BFSI segment is still not moving into double-digit earnings growth. Even in this quarter, we saw 3.3% earnings growth for the 231 non-BFSI companies reported. This number was negative 11% for the last 9 months in this fiscal year, 23. So clearly, if we see opportunities emerging on the non-BFSI space, then a part of the capital will be reallocated from BFSI to non-BFSI. But as we speak today, I think BFSI space valuations are not very expensive out of that. And I think this space should remain bidded in times to come as well. But earnings moderation will definitely happen. And hence, the return expectation should not be what we saw in the last 12 months, but should be more moderated as we move towards the FY24 end.
The earnings expectations should be a bit more moderated, but Pankaj, I don't see any auto name in your top stock holdings or the preferred sector list. Why is that?
So we are playing auto through auto ancillaries. And especially in the mid and small cap space, if you look at the broader market space, auto ancillary is the larger portion. But however, in our multi-cap, flexi-cap and large cap funds, we are overweight on autos as a sector. And I think that sector is doing reasonably well. Even in this fourth quarter, we have seen decent earnings momentum by the auto sector, both on four-wheelers as well as two-wheelers.
You and just curious about your take on new age tech, given the kind of treatment they've been met with when they listed, and then of course that wake up call, the path to profitability focus. How have you looked at the journey of any of these companies? Would you like to walk us through anything in specific that stood out?
So when most of these companies were getting listed, we were extremely cautious. We couldn't understand how to value these companies, which were not talking about cash flows, which were not talking about profitability. But over a period of time, the entire environment has changed on the cost of capital. Earlier in US, for getting 5%, you used to invest in junk bonds. Today, you can get that 5% through US Treasury. So in the last 15 months, there has been a sea change in the way you approach the cost of capital argument. And that's very relevant from the entire unlisted and the new age tech companies, which always for the last decade or so has seen easy liquidity and zero cost of capital. And for them, burning cash was very easy. We need to see how most of these companies locally and globally transit themselves from a mindset and a DNA perspective to profitability path and cash flow path. A couple of companies in India which got listed in 2021 have already started talking about in their commentary of path to profitability, which is a welcome change. Also, a lot of companies have made earlier mistakes on communication, some of the other issues on capital allocation. And I think they are learning their way out. So at relevant point of time, definitely it's on our radar. And we are evaluating a couple of them, which have leadership positions, strong moats. And once we see the unit economics working in our favor and the overall approach of the companies towards cash flows and profitability, we'll definitely have a look. But globally speaking, we are worried that I think the pain in the private space has just yet started. It's still, in the early stage where capital is drying up for for the new age companies which don't have a business model. And I think the next round of funding for a lot of companies which need capital will not be so easy what we saw in the last decade or so. So there could be higher mortality rates we should be prepared of. And if you look at the entire funding in the last 6 to 8 months, there have been very few deals where funds have gone and done the second round or the third round. So the space needs to be approached with a little bit of caution. But in adversity lies opportunity. And we are open minded that if we get any good company with strong economic moats, we won't like to shy away from them.
All right, appreciate your time. Thanks very much, Pankaj, for joining in and sharing with us your market outlook.